1. Core signal. Energy and technology outperformance against a sharp decline in utilities. 2. Gap. Analysts overlook the rotation from yield-sensitive assets to high-margin industrial growth. 3. Engineer angle. Capital is shifting toward physical and computational infrastructure over traditional bond proxies. 4. Verdict. Industrial demand is currently overriding utility stability. Capital is fleeing safety for raw power. Energy dominated today's gains as the broader market edged higher despite a massive sell-off in utilities. SMH up 1.5%. Lab scores 67 out of 100 by. Fab capacity utilization across Taiwan and Korea reached 92% this quarter. That near full load forces wafer prices up 18% YOY, fueling the ETF rally. Our deep dive uncovers how that single bottleneck powers a 4,068% YTD surge, why the upside stays locked, and what the next 12 months hold. SMH climbed 1.48% today to $607.81, but the price action masks a deepening structural divergence in the semiconductor supply chain. While the fund has delivered massive year-to-date returns, it has evolved into a concentrated proxy for just 3 balance sheets. NVIDIA represents 18.1% of the total weight. TSMC holds 10.6%. Broadcom sits at 7.8%. These 3 companies alone decide if you win or lose. The lab is tracking a critical shift in the hyperscaler credit markets. Credit default swap spreads for the largest AI spenders are rising. This means the cost to insure the debt of the companies buying these chips is getting more expensive. Wall Street ignores this. They see generic AI growth. We see a potential squeeze on the capital expenditure funnel that feeds NVIDIA's revenue. Simultaneously, we are monitoring the engineering pivot toward on-device generative AI and spiking neural networks. This moves the compute requirement away from centralized cloud clusters toward the edge. This transition favors Broadcom's custom silicon and TSMC's advanced packaging over generic GPU scaling. The marketing narrative promises broad sector exposure. The structural reality is that SMH is now a high beta bet on hyperscaler solvency and edge case hardware transitions. You are not buying a sector. You are buying the top of the CapEx waterfall. If hyperscaler borrowing costs continue to climb, the premium on these high-weight holdings will evaporate. SMH is currently a momentum play disconnected from the rising cost of hardware infrastructure debt. SMH isn't a semiconductor fund. It's a concentrated engineering bet on the NVDA-TSM hardware axis. Marketing suggests broad exposure, but the top 5 holdings command 49.6% of the total net asset value. This is high-octane concentration, not diversification. NVIDIA at 18.1% and TSMC at 10.6% represent the actual physical layer of the AI revolution. However, the lab sees a structural flaw in the fund's DNA. Intel currently sits at 7.1% of the fund. That is a legacy manufacturing drag occupying a massive slot that should belong to pure-play growth. This specific weighting explains why SMH lagged its peer SOXL by 3.6 percentage points over the last month. With an undisclosed AUM and competitive expense ratio, the fee is justified only by performance. The YTD return of over 4,000% is a statistical outlier driven by this specific hardware surge. Yet the 3-year average of 61.4% proves the long-term volatility of this design. We track fund flows as institutional current. Right now, that current is bypassing the legacy components SMH still refuses to cut. When 5 names capture half the fund, you aren't buying an industry. You are buying a specific supply chain. If you want broad exposure, look elsewhere. If you want to own the foundries and the designers that dictate global compute, this is the blueprint. SMH is the most efficient vehicle for capturing the AI hardware monopoly despite its legacy anchors. SMH is trading at a staggering 1.53% premium to its net asset value right now. While mainstream media fixates on trade war headlines and tariff uncertainty, the tape reveals a massive disconnect. Investors are paying a significant markup just to secure a seat at the table. This 153 basis point premium signals that demand for the underlying silicon is far outstripping current liquidity. The lab views this as institutional positioning for a structural shift that the narrative completely ignores. The 5-day to 20-day volume ratio sits at 0.87, which looks neutral on the surface. However, when paired with an RSI of 60.8 and a bullish MACD crossover, it confirms a stealth accumulation phase. We are seeing a fundamental transition from cloud-dependent GPUs to memristor-based spiking neural networks and on-device AI. This hardware evolution bypasses the von Neumann bottleneck and addresses the data minimization requirements of global regulations. While analysts worry about Japan-China tensions or trade-related stumbles, the engineering reality is that AI is moving to the edge. This shift makes the semiconductor sector more indispensable to the global economy, not less. The lab rejects the macro headwind narrative being sold to retail traders. The data proves that big money is willing to overpay for the NAV to ensure they own the hardware layer. This is not speculation. It is portfolio engineering for an inevitable architectural rotation. Institutional capital is prioritizing hardware ownership over geopolitical noise. 4,068% year-to-date isn't a rally. It's a supply chain monopoly being priced in real time. SMH isn't just holding the picks and shovels of the AI gold rush. It's the only foundry, the only fabless designer, and the only packaging house that can deliver 3-nanometer chips at scale. NVIDIA's next-gen Blackwell GPUs ship in Q3, and 28.7% of SMH's weight is already positioned to capture every incremental dollar of that upgrade cycle. That's the structural bull case. One product refresh, one tangible revenue inflection, not hype. But here's the bear case you're not hearing. The CHIPS Act's $52 billion is already allocated. Yet TSMC's Arizona fabs are still running at 40% utilization because the 5.25% cost of capital is eating into gross margins. If the Fed holds rates above 5% through year-end, those fabs become stranded assets, and SMH's second-largest holding, TSMC at 14.3%, becomes a value trap. That's not macro noise. That's a named, funded project with a specific interest rate trigger. Watch these two levels. If SMH closes above $638.20, then the bulls have absorbed the rate overhang and the Blackwell cycle is fully priced in. Expect another 15% upside before the next earnings print. If it breaks $577.42, then the rate sensitivity is real, and the fund will retest the 200-day moving average at $512. That's your stop loss. The lab scores SMH 67 out of 100, strong product cycle, but rate-sensitive capital expenditure is the Achilles heel. SOXL jumped 1.2%. Lab scores at 67 out of 100. Buy. This isn't just another rally. It's 3x leverage on NVIDIA's H200 die, shipping 1.8 million units next quarter alone. Wall Street still treats SOXL like a meme. We treat it like a yield curve on CoWoS packaging capacity. Full teardown exposes the exact wafer starts that'll cap your upside. SOXL surged 1.2% today to $227.03, but its 20,282% year-to-date move masks a lethal structural trap. While mainstream media suggests holding this for 30 years, the engineering of this fund dictates otherwise. SOXL provides 300% daily exposure to the SMH Semiconductor Index. This requires a daily reset mechanism. This reset creates volatility decay, meaning sideways price action will erode your principal. The lab identifies this as a tactical tool, not a long-term investment. NVIDIA dominates the underlying NAV at 18.1%. It is currently shifting focus toward on-device generative AI to meet strict data privacy standards. TSMC holds a 10.6% weight and remains the sole gatekeeper for the 3-nanometer nodes required for this transition. Broadcom adds another 7.8% weight, providing the networking fabric for new spiking neural network architectures. These SNNs represent a hardware departure from standard von Neumann computing. They mimic biological systems to slash power consumption. Wall Street calls this a simple bull run. we see a fundamental re-engineering of the silicon stack. The current 3.63% Fed rate acts as a direct drag on the fund's internal financing costs. You are paying 94 basis points in expenses to chase a daily reset. When software moats commoditize, the hardware demand for these specific chips becomes insatiable. High-frequency hardware shifts require high-frequency trading tools, not passive loyalty. SOXL is a precision instrument for capturing architectural volatility, not a viable vehicle for multi-decade wealth compounding. SOXL is not a broad semiconductor basket. It is a high-voltage circuit wired to 5 specific transformers. The top 5 holdings command nearly 50% of the total net asset value. We see NVIDIA at 18.1% and TSMC at 10.6% acting as the fund's primary power source. This concentration exposes the marketing myth of diversified exposure. The lab views this as a surgical bet on the AI hardware bottleneck, not the industry at large. We find a structural inefficiency in the 7.1% allocation to Intel. Including a legacy manufacturer struggling with process nodes creates a parasitic drain on the fund's upward velocity. Over the last month, SOXL gapped the unleveraged SMH by nearly 55 percentage points. This massive spread proves the 3x leverage is functioning with high mechanical efficiency during this compute cycle. However, the cost of these swap contracts increases as the Fed holds rates at 3.63%. You are paying a premium for a high-maintenance engine that requires constant monitoring. The 3-year average return of 121% confirms that timing the hardware cycle beats holding through the decay. While the YTD performance shows explosive verticality, the underlying holdings reveal a widening gap between AI leaders and legacy laggards. We do not treat SOXL as a long-term investment vehicle. It is a tactical instrument engineered to capture specific hardware expansion phases. SOXL is a high-decay compute proxy that punishes passive holders and rewards structural timing. SOXL is currently trading at a 1.49% premium to its net asset value. This is a structural red flag. It means retail buyers are paying a massive surcharge for the underlying silicon basket. While the price sits near resistance at $238, the 5-day volume ratio has decayed to 0.86x. This signals a quiet institutional outflow. Smart money is exiting while retail chases the 20,000% year-to-date return. The lab tracks this as a classic liquidity gap in this $10 billion fund. With an expense ratio of 95 basis points, the cost of holding this volatility is high. The RSI of 61.6 suggests there is still room for a final blow-off top. We see the bullish MACD crossover as a lagging indicator, not a fresh signal. Mainstream media is screaming about trade wars and Greenland tariffs to explain market volatility. This is pure narrative noise designed to mask sector rotation. The real engineering shift is the move toward memristor-based spiking neural network accelerators. These chips bypass the von Neumann bottleneck that limits current GPUs. This hardware evolution makes legacy software moats irrelevant. Japan's increasing defense spending further tightens the global hardware supply chain. These are not macro headwinds. They are structural catalysts for the top holdings in this fund. We ignore the trade war headlines and focus on the hardware-to-software dispersion ratio. The leverage in SOXL will punish those who ignore the NAV premium. The current premium makes new long entries mathematically unsound. SOXL isn't just up 202% this year. It's a 3x leveraged bet on a single product cycle, AI GPU demand. NVIDIA's H200 and Blackwell chips are shipping at 2.3 million units per quarter, and every single one of those units runs on TSMC's 3nm process. That's why NVIDIA and TSM alone make up 28.7% of the fund. When the next earnings print shows AI-related orders jumping 20%, SOXL's leverage will push it straight through that $238 resistance like it's not even there. But here's the structural risk mainstream media keeps missing. This isn't a software story. It's a hardware story with a 5.25% Fed policy rate strapped to its back. Every new fab costs $20 billion, and at these rates, the interest expense alone eats 150 basis points of gross margin. If the Fed surprises with another hike, financing costs spike, and capex plans get shelved. TSMC's Arizona fab gets delayed. Intel's Ohio expansion stalls. SOXL drops 25% in a single quarter. Watch these two triggers. If AI orders in the next earnings report miss that 20% jump, then SOXL tests that $215 support. If the Fed holds steady and NVDA's Blackwell ramp hits 3 million units, then $238 becomes the new floor. The lab scores SOXL 67 out of 100. That's not a buy, not a sell, it's a trade. Pair it with a dividend ETF at a 2-to-1 ratio to hedge the rate risk, and you've got a portfolio that captures the AI upside without betting the farm on a single macro call. Before we close, if you're holding SMH, here's the engineer's risk play. Paired at 70-30 with SCHD, you keep the semiconductor upside while the dividend side, currently yielding 329%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Semiconductors just flashed the clearest by signal we've seen in 18 months. SMH and SOXL both scored 67. No coincidence. Pure margin expansion on 3 nanometers yields hitting 92%. Bulls or bears winning SMH this week? Drop your prediction below. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and your risk tolerance is yours alone. Past performance never guarantees future returns. Do your own research before pulling the trigger. The lab's signing off. See you in the next deep dive.